Welcome to the Daily Stock Beaver Market Briefing. Today is July 31, 2026, and we're going to dive straight into the market snapshot. The NASDAQ rose 1.0% on Amazon's best session since 2012. Oil jumped 3.28% after Iran halted vessels in the Strait of Hormuz. Bitcoin fell below $63,000, losing $3,000 in 12 hours, and three Fed governors dissented, demanding a rate hike. Four storylines, one market, and here is the story. The week's dominant force was a Federal Reserve in disarray. Chairman Kevin Warsh held rates unchanged, but three governors broke ranks to demand a quarter-point hike. Investors initially read his press conference as dovish, yet his prepared remarks hinted at a tighter bias. The 10-year Treasury yield posted its largest monthly gain since March. That bond sell-off deepened when the Bank of Japan spent an estimated $50 billion defending the yen, triggering Treasury selling and sending the dollar index down 1.4% on the week. This policy crossfire is the backdrop for everything else. Amazon and Microsoft justified the AI spending surge with their cloud results, while Apple fell on memory cost inflation. Energy rallied as Iran's disruption lifted oil, and Chevron posted a $12.1 billion quarter. Coming up, we will unpack what surging Treasury yields mean for your portfolio, and we will dig into why gold and silver are diverging from the equity rally. Earnings season delivered the counter-narrative. Amazon's Q2 results were the standout. Revenue of $200.6 billion, up 20%, with Oz accelerating to 37% growth and a $496 billion contracted backlog. Microsoft matched the momentum with revenue of $90 billion, up 18%, Azure growing 43%, and forward guidance for even faster cloud expansion. Apple posted June quarter revenue of $109.4 billion, up 16%. But shares fell as Tim Cook described a 100-year flood in memory pricing that would squeeze margins further. Chevron earned $12.1 billion, its strongest quarter in 6 years, capitalizing on the geopolitical premium in oil. And AbbVie topped revenue estimates on SKYRIZI strength, but trimmed its full-year EPS outlook to absorb Apogee acquisition costs. The pattern today is selective risk appetite, not broad risk-taking. The NASDAQ's 1.0% gain masks a narrow rally concentrated in megacap earners, while the Russell 2000 fell 0.5% and Bitcoin dropped nearly 3%. When leadership narrows this tightly, the market grows more vulnerable to a single disappointment. Here are the numbers. The S&P 500 rose 0.7% to 7490. The NASDAQ climbed 1.0%. The Dow gained 0.53%. The Russell 2000 fell 0.5%. The VIX Fear Index sits at 15.99, calm but watchful, consistent with a neutral market regime. Long-term Treasury bonds, ticker TLT, fell 0.66%. The 10-year yield rose to 4.67%, and the 30-year climbed to 5.2%. The national debt stands near $40 trillion, up about $41 billion today alone, and we will dig deep into the federal budget later in the show. Gold fell 1.27% to about $4,108 an ounce. Silver dropped 1.61% to $58.6, and we will go much deeper on precious metals coming up next. Oil surged 3.28% to $86.33, a clear inflation signal, and Bitcoin fell 2.83% to about $63,000. 6 sectors rose, 8 fell, and the split tells a clear rotation story. Consumer discretionary led the entire market, up 2.71%. Almost entirely on Amazon's post-earnings surge lifting the sector single-handedly. Software gained 1.36% on Microsoft's Azure momentum. Energy added 1.2%, a direct beneficiary of the Strait of Hormuz tension and Chevron's 6-year high profit. Semiconductors barely held positive at 0.7%, a surprisingly muted reaction given NVIDIA's 85% revenue growth and Broadcom's AI semiconductor revenue of $10.8 billion, up 143%. Investors are clearly growing selective about chip valuations after July's sell-off in names like Micron. On the losing side, materials was the clear laggard, down 2.38%, after Treasury Secretary Scott Bessent's warnings to China over rare earth restrictions escalated tariff fears. Healthcare dropped 0.76%. The defensive trio of utilities, real estate, and consumer staples all declined as investors rotated toward risk. And broad technology fell 0.38% despite the megacap earnings, with Apple's supply chain warning and Meta's margin compression offsetting Amazon and Microsoft's strength. The takeaway: today's gains are concentrated in a handful of names, and market breadth is not confirming the headline index move. Weekend Review. The defining story this week was narrow leadership masking a significant rotation underneath. The S&P 500 gained 1.5%, and the NASDAQ climbed 1.59%, solid headline numbers. But the Russell 2000 was essentially flat at 0.5%. That gap tells you who actually benefited. A handful of large companies delivering strong earnings, not the broader market. Here is what makes this fascinating. The Russell leads all four indices year-to-date at 16.87%, yet it could not find buyers this week. That divergence between annual leadership and weekly stagnation is a rotation signal worth watching. The most striking story lives inside technology itself. Software surged 7.5% this week, the best sector by a wide margin, yet remains down 7.83% year-to-date. That gap between a blistering weekly gain and a negative annual return is a textbook catch-up trade, capital flowing into a sector that trailed the market for most of the year, finally finding buyers who believe the laggards deserve a second look. The mirror image is semiconductors, down 4.2% this week despite being up nearly 61% year-to-date. When your strongest annual performer pulls back while your weakest tech cousin surges, you are watching profit-taking from crowded winners and rotation toward undervalued laggards in real time. The defensive sectors confirm this is a targeted rotation, not a broad rally. Utilities tumbled 4.13% as investors unwound safety positioning. Consumer discretionary gained 5.19%, with Amazon's post-earnings surge lifting the sector single-handedly. 6 sectors rose and 8 fell, with an average sector return of just 0.26%. That average, barely above zero, tells you the headline index gains are being driven by a narrow group of megacap names, not broad participation. The cross-asset picture adds texture to that rotation. The dollar weakened 1.42% this week after the Bank of Japan's estimated $50 billion yen intervention forced currency adjustments globally. That whittles the dollar's year-to-date gain down to just 1.42%. The weekly move erased nearly all of the dollar's annual advantage. Crude oil fell 3.34% on the week, but remains up nearly 50% year-to-date, a divergence that signals profit-taking after weeks of Iran-driven gains rather than any fundamental easing of supply concerns. Gold managed a modest 0.91% weekly gain, but both gold and silver remained stubbornly negative on the year, silver down over 20%. That precious metal's weakness, in a week of Fed dissent and geopolitical escalation, is one of the most telling signals in the data. Bitcoin dropped 3.75%, deepening its 29% year-to-date loss even as institutional ETFs pulled in inflows. The 30-year Treasury bond fell 1.5% on the week and is down 5.65% year-to-date, with the 10-year yield reaching its highest level since 2007. The through-line across all these assets is repositioning, not panic. A weaker dollar alongside falling bond prices and soft precious metals tells you investors are rotating within risk assets rather than fleeing to safety. The irony is striking. Gold and silver, the traditional hedges against Fed dysfunction and geopolitical risk, are being ignored while the 10-year Treasury at 4.67% absorbs the safe haven capital instead. The July jobs report next week will be the decisive catalyst. Now let us get into the commodities deep dive. Commodities. The dominant commodities story is a geopolitical premium baked into energy that is running headlong into a Federal Reserve threatening to tighten further. Heating oil futures are up 94.1% year-to-date, and wholesale gasoline up 83.3%. These are staggering numbers for refined products. They tell you the supply chain is absorbing geopolitical risk at the refinery level, not just at the wellhead. But these gains are fading on a weekly basis, with gasoline down 8.3% over 7 days. That weekly pullback after a massive annual surge is the market asking whether the geopolitical premium has overshot. Wheat remains up 37% on the year, anchored by disruptions to Black Sea and export terminal logistics. Energy is catching its breath after a torrid geopolitical run. WTI crude sits at $84.53, down 5.4% on the week. The pullback follows weeks of escalating supply fears, Iran halting vessels in the Strait of Hormuz, a drone attack forcing Russia's Ryazan refinery to halt processing, Kazakhstan's main Black Sea export terminal shutting down for the third time this month. According to EIA data, crude inventories drew down 3.8 million barrels to about 308 million. That draw matters because it confirms real physical tightness underneath the geopolitical noise. This is not just speculation. It is a market where inventories are genuinely contracting. The EIA fundamentals confirm a supply-driven market, not a demand surge. That 3.8 million barrel crude draw represents a 1.2% week-over-week decline, consistent with normal summer seasonality rather than panic buying. The genuine anomaly is refinery utilization, which the data implies dropped roughly 18 points week over week. If confirmed, that signals hurricane, fire, or unplanned maintenance, events that would tighten product supply precisely when heating oil is already up 94% year-to-date. Abu Dhabi's national oil company, buying 5 supertankers for $590 million underscores how physical traders are repositioning for prolonged shipping disruptions through Hormuz and the Red Sea. Our internal positioning analysis reveals an extraordinary setup in energy. Big traders, hedge funds and CTAs have piled into gasoline futures at the 98.6th percentile of the past 6 years, within touching distance of the maximum on record. There is almost no marginal buyer left if sentiment turns. Meanwhile, the producers who actually drill and refine are barely hedging. Their hedge ratios sit below the 10th percentile across crude, gasoline, and heating oil. When the industry that knows the business best refuses to lock in prices at these levels, they are telling you they expect the geopolitical premium to persist or climb further. The danger is asymmetric. If Iran tensions ease, that gasoline position unwinds violently with no one left to absorb the selling. The precious metals story is surprising weakness despite a backdrop that should support it. Gold sits at $4,104, down 5.2% year-to-date. Silver is worse, down over 18% on the year, with 3 Fed governors dissenting to demand rate hikes and geopolitical tensions escalating on multiple fronts. You would expect gold to be soaring. Instead, surging Treasury yields are competing with bullion for safe haven capital and winning. Copper diverges sharply, up nearly 15% year-to-date, confirming that industrial demand remains intact even as the precious metal hedge thesis falters. That divergence, industrial copper rising while monetary gold falls, tells you the market is pricing growth and inflation, not crisis. Our smart money analysis reveals a striking gold-silver divergence that most investors are missing. Managed money, hedge funds, hold gold longs at the 91st percentile of 6 years, firmly bullish. Gold producers, meanwhile, barely hedge at the 6th percentile, signaling they expect prices to keep climbing. But silver longs sit at just the 8th percentile, near the smallest position in our entire dataset. Funds are treating gold as a pure safe haven, while dismissing silver's industrial demand exposure given the China geopolitical risk. Palladium carries a moderate danger flag, with 53% of open interest on the short side. Any disruption to Russian-origin supply would force a violent squeeze. Agricultural futures are pulling back after strong year-to-date gains. Wheat fell 5.1% this week, but remains up 37% on the year. Corn dropped 4.8%. These are wholesale futures prices. What you see at the grocery store follows with a lag and a smaller magnitude, but the direction matters for your food budget. Cocoa surged 5.5% today on persistent West African supply concerns, extending its role as one of the most volatile commodities this year. Our positioning data flags cocoa as the most contrarian setup in agriculture. Big traders are at the 0.5th percentile for long positions, the lowest reading in 6 years of data. That is a near-total absence of bullish conviction, meaning any West African weather disruption forces short covering with virtually no longs to absorb the squeeze. Meanwhile, corn saw aggressive accumulation this week, with traders adding over 75,000 contracts, the largest velocity reading in our agricultural coverage. That kind of sudden build typically signals a weather premium being priced in. Now let us see how the dollar is holding up against the world's major currencies. Currencies. The dollar weakened against every major currency this week, and the catalyst is central bank divergence. The yen surged 3.7% against the dollar after the Bank of Japan spent an estimated $50 billion intervening and delivered a hawkish hold, catching hedge funds off guard who had been betting the yen would keep sliding. The euro strengthened 1.5% as investors judged the European Central Bank's steady hand more credible than a Federal Reserve in open disarray with 3 dissenting governors. The British pound gained 1.3%, trading around 1.3443 after its strongest 2-session rally in months. The dollar index fell 1.42% this week, leaving it barely positive on the year at 1.42%. That convergence, the weekly decline erasing nearly all the annual gain, tells you the dollar's strength narrative is fraying. In emerging markets, the stories diverge sharply. The Brazilian real has been the standout, strengthening 7.5% year-to-date on commodity export strength and aggressive rate management. But the Turkish lira continues its slow-motion slide, down 10.5% year-to-date, and the Indian rupee weakened 6% despite its growth narrative. The Mexican peso gained 3.7%, and the Chinese yuan strengthened 3.5%, even as Treasury Secretary Bessent escalated warnings over rare earth restrictions. That resilience against a backdrop of trade tension escalation tells you the dollar's weakness is doing real work in global portfolios. Our internal positioning data reveals the single most crowded trade in our entire coverage. Leveraged funds have the euro short at the 99.8th percentile, essentially unmatched in the dataset's 6-year history. Hedge funds are betting heavily that divergent central bank policy will push the euro lower. But asset managers, the pension funds, disagree. They are 50% long the euro, treating the sell-off as overdone. When leveraged funds and institutional money are on opposite sides of a position this extreme, something has to give. The yen carries a moderate danger flag with shorts at the 90th percentile, directly threatened by the Bank of Japan's intervention. When a central bank forces a currency higher while hedge funds are positioned 37% short against it, the unwind becomes mechanically forced. For travelers, your dollar stretches slightly further in Europe and Canada than it did in January, but buys less in Australia and Britain. The broader message for your portfolio is this: a Federal Reserve that cannot speak with one voice erodes the dollar's standing, and a weakening dollar tends to lift international stock returns when converted back to greenbacks. Let us turn now to the Treasury market. Treasury and Rates. The yield curve is telling a story of a market caught between a fractured Federal Reserve and surging fiscal deficits. The 10-year Treasury yields 4.67%, the 30-year sits at 5.2%, and the 2-year has dropped to 4.22%. The 10-year minus 2-year spread is positive at 0.45, meaning the curve is no longer inverted. That matters enormously because the inverted yield curve has been the single most reliable recession predictor of the past 50 years. But the way this curve is steepening, with long rates rising while short rates fall, is not the kind that signals healthy growth ahead. It is what happens when bond investors demand ever higher compensation for lending to a government whose borrowing trajectory shows no sign of stabilizing. For retirees, a 4.22% 2-year Treasury means certificates of deposit and money market funds finally pay real income. But if you are a borrower, especially a homebuyer, the math has fundamentally changed. FINRA data shows about $1.45 trillion in daily Treasury trading volume, with a roughly 51% dealer customer share indicating balanced real money participation rather than a panic exit. The trading is concentrated in the 2 to 5 year range, exactly where the rate debate is most intense. Separately, FINRA margin debt hit $1.5 trillion in June, up 49% year over year. That level of leverage near market highs is a late-cycle warning, the kind of positioning that amplifies any negative catalyst into a forced deleveraging cascade. Our smart money analysis shows Treasury shorts at extraordinary levels. Big traders are short the 10-year Treasury at the 87.7th percentile of the past 6 years, holding over 2 million net short contracts. The banking system is positioned right alongside them, with dealer shorts at the 96th to 97th percentile across the curve. But pension funds and institutional investors are on the opposite side. Asset managers are 52% to 59% long across maturities, treating this sell-off as a buying opportunity. This is a direct, high-stakes disagreement about where rates go next. If the July jobs report disappoints, that inflation narrative inverts overnight, and a massive short position becomes extremely painful to maintain. In stock index futures, the positioning confirms a cautious professional stance. Hedge funds are net short the S&P 500 by about 280,000 contracts. The VIX, the market's fear gauge, carries our only high-risk flag in the entire dataset. Big traders built VIX longs to the 99.2nd percentile, positioning for a volatility spike. But our system detected a reversal this week as that protection did not pay off. If the bond market cracks, those traders will need to rebuild protection at any price. Bitcoin sits at 50.4% short with moderate reversal risk on any dovish Fed surprise. The picture across all categories is one of incompatible bets. Traders are simultaneously positioned for Fed hawkishness, with massive shorts in treasuries, the euro, and Bitcoin, and for systemic stress, with gold longs at the 91st percentile, gasoline at the 98th, and VIX at the 99th. Those two worldviews cannot both be right. Our stock Beaver positioning analysis, as of July 28, flags the VIX as our highest risk contract, with the euro short at the 99.8th percentile and gasoline longs at the 98.6th as the most dangerous crowded trades across the entire market. If you own energy positions riding this geopolitical premium, recognize how tightly packed that trade has become. The July jobs report next week will be the catalyst that resolves this tension. Now let us pull back and look at the bigger economic picture, what the Fed is doing, how jobs are holding up, and where the economy goes from here. Economy and the Fed. The recession clock reads slowdown, with an imminent score of 31.5 out of 100. That number tells you the leading edge of the economy is softening, but no recession signal has triggered yet. Two components drive that read. The SOM rule, the early warning jobs trigger, sits at 0.17 percentage points, well below the 0.50 tripwire that marks the start of a downturn. That gap means the labor market has not broken enough to ring the bell, but the direction of travel matters more than the level. And the yield curve has steepened back to normal, with the 10-year minus 3-month spread at plus 0.86%. When an inverted curve snaps back like that, it is historically the most imminent recession tell, but it needs corroboration. Building permits down 1.8% year over year, and cyclical factory payrolls barely growing at 0.1% are doing that corroborating. The GDP and headline payrolls numbers only confirm what the leading edge already told us months ago. This week's scoreboard tells a story of tension between a cooling real economy and still calm financial markets. The Atlanta Fed's GDP Now tracker slipped to 1.5% annualized growth, missing the 1.6% consensus. That miss matters because the GDP Now model aggregates high-frequency data in real time, so when it disappoints, it is the market's first whiff of a softer-than-expected quarter. Initial jobless claims rose to 197,000, up 9,000 from 188,000 the prior week, a modest bump, but one that reinforces the claims creep we have been tracking. And durable goods orders came in at just 0.3% growth against expectations of 2.5%, a dramatic miss that confirms the factory side is losing momentum. Yet the VIX fell about 9%, and financial conditions actually loosened. The bond market is tightening, the stock market is relaxing, and that divergence is the whole story of this week. The GDP Now tracker's slip to 1.5% is the forward-looking number that matters, not the $32.5 trillion headline GDP, which lags by definition. Durable goods at 0.3% versus 2.5% expected confirms the factory side is cooling. Meanwhile, the services economy is still expanding, with the S&P Global Services PMI beating estimates at 53.6. That split, resilient services and softening manufacturing, is exactly what a late-cycle slowdown looks like before it broadens. The forward tracker and the factory orders are telling you where things are going, and they are not going up. The Chicago Fed's National Financial Conditions Index sits at minus 0.55, meaning credit is flowing freely. Conditions are easier than historical average. The St. Louis Stress Index at minus 0.83 reinforces that reading deep in calm territory. This is the paradox the three dissenting Fed governors are reacting to. If conditions are this easy with inflation still above target, the current rate stance may not be restrictive enough. The risk appetite component at minus 0.62 is the loosest slice of the entire index. Investors are reaching for return, not pulling back. Conditions this loose are fuel for growth, but also for the inflation the Fed has not yet defeated. Initial claims at 197,000 are the freshest read we have, and while claims remain historically low, the recent bump from 188,000 is worth watching because the sparkline shows a grinding drift higher over recent weeks. The broader monthly picture is from June, now 60 days old, with unemployment at 4.2%. But the telling detail beneath the headline is the distribution of joblessness. Short-term unemployment, people jobless less than 5 weeks, surged 31% in June, while long-term unemployment actually eased 8%. That divergence signals a labor market in transition. New layoffs are accelerating even as the long-term jobless find work, which means the churn is picking up but the hiring side has not cracked. That is not a clean improvement story. The 30-year fixed mortgage rate climbed to 6.66% this week, up 8 basis points, and 29 basis points higher than a year ago. For anyone house hunting, that is the direct cost of the bond sell-off we described earlier. June new home sales topped expectations at 628,000 units, which sounds strong until you note that building permits fell 2.6% month over month. The market is clearing current inventory, but builders are not pulling new permits. They see the affordability wall before the sales data reflects it. Rising rates and rising prices together build that wall higher every month, constraining the housing pipeline even as current demand holds up. The VIX dropped to 17.9 this week, down about 9%, putting broad market fear in the normal range. But the cross-section reveals where nervousness persists. The NASDAQ 100 VIX sits at 27.55, elevated, reflecting tech earnings uncertainty, and the Economic Policy Uncertainty Index spiked 89 points in a single day to 310, driven by the Fed's communication chaos. When market volatility falls but policy uncertainty surges, that gap typically closes, and history suggests it is the calm market that adjusts to the uncertainty, not the other way around. The Fed's balance sheet contracted to $6.74 trillion, down about $9 billion on the week, but the composition tells the real story. Mortgage-backed securities fell nearly $14 billion this week alone, and that runoff is the direct mechanical pressure keeping mortgage rates elevated even when the 10-year Treasury holds steady. Meanwhile, the reverse repo facility is down to just over $1 billion, nearly depleted after absorbing excess liquidity for years. That matters because it means quantitative tightening is now biting directly into bank reserves, which fell 2.5% this week to about $3 trillion. Reserve scarcity is the boundary that historically forces the Fed to halt tightening, and the system is approaching it. FINRA margin debt reached $1.5 trillion in June, up 49% year-over-year and 6% month-over-month. That year-over-year growth rate is the number to focus on. Above 30% has historically preceded major market tops, and at 49%, investors are running heavily on borrowed money at the precise moment the leading economic indicators are rolling over. This connects directly to the recession clock and the financial conditions. Easy money has fueled leveraged risk-taking, and when the leading indicators roll over, that leverage amplifies the unwind. The 5-year Treasury yield is really two components stacked together: the break-even, which is the inflation investors expect over the next 5 years, plus the real yield, the return above inflation they demand. Add them and you get the nominal yield. Right now the break-even sits at 2.24%, essentially flat over the past month. The real yield stands at 2.41% and has climbed 8 basis points over the past year while the break-even actually dropped 4. That divergence is the entire story. Rates are rising because investors want a higher inflation-adjusted return, not because they fear more inflation. That is tightening in real terms, and it is the market doing the Fed's hawkish work for free. The Fed can hold rates steady and still get tighter conditions. For gold, this is the specific headwind. A rising real yield increases the opportunity cost of holding an asset that pays no interest, and gold's turning point comes only when the real yield peaks and rolls over, not while it is still climbing. The oil yield correlation teaches us how supply shocks transmit into interest rates, but the channel matters enormously. The textbook story, higher oil pushes inflation expectations up, lifting yields, only holds when the break-even line is actually moving. Our decomposition shows break-evens flat, which means the geopolitical oil premium is landing in the real yield instead. The market is treating oil as a tightening force and a growth constraint, not as an inflation accelerant. This is the Fed's look-through response working as designed. Anchored expectations let the Fed hold rather than hike into an oil shock. But it also means the Fed will not cut, because easing into supply-driven headline inflation, even with expectations well-behaved, risks unraveling the discipline the bond market is currently enforcing. This week's data reinforces the recession clock's slowdown verdict. The real economy is cooling while financial markets stay calm, and the July jobs report next week will test that divergence. Now let us see what corporate earnings say about conditions on the ground. Earnings pulse. 3 sectors made the cut this week. Utilities is first. 3 of 6 companies beat EPS estimates, only 1 raised guidance, and the dominant tone is bullish despite the sector posting the worst weekly return of any group, down 4.1%. Then financial services, the heaviest reporting week with 19 calls in 7 days, 5 of 6 beat EPS, 1 raised guidance, tone bullish. Finally, consumer defensive, 5 of 6 beat EPS, and remarkably 5 of 6 also raised guidance, but the tone is mixed. Let's break them down. The thesis for utilities this week. In a sector historically defined by regulatory mediation, the companies that have engineered self-reinforcing pricing flywheels are pulling irreversibly ahead. Nowhere is that clearer than the contrast between American Electric Power, ticker AEP, and Edison International, ticker EIX. AEP's management raised full-year 2026 EPS guidance by 10 cents to a range of $6.25 to $6.55, citing what they called unprecedented demand. The company has contracted 69 gigawatts of new large load additions through 2030, led by 45 gigawatts in Texas alone, backed by $2 billion in collected cash and collateral from well-capitalized hyperscalers. Large load tariffs approved in 5 jurisdictions shift infrastructure costs directly to those big customers, with AEP projecting up to $16 billion in offsets for existing residential ratepayers. The stock was down just 1.2% since the call, the best reaction in the group. Edison International, by contrast, beat on EPS but struck a cautious tone. Management warned that California wildfire legislation is stalled with just 4 weeks left in the legislative session, and no bill language yet. SCE's credit rating sits at BBB, what management called nowhere to go in investment grade, and they explicitly warned of potential multi-sector credit downgrades absent a financeable wildfire framework. The stock fell 6.7%, the worst in the sector. In between, Southern Company's CEO reported the strongest first-half demand growth in nearly 2 decades, with data center usage surging 55% year-over-year and a landmark 25-year, 3.2 gigawatt agreement with OpenAI in Georgia. American Waterworks demonstrated a different kind of pricing power entirely, growth funded through built-in regulatory rate increases as it acquires more municipal water systems. And Exelon's management pointed to PJM capacity auctions clearing at the price cap as evidence that grid scarcity is giving utilities leverage to fund massive investment programs. The financial services verdict this week cuts to the bone. The sector's winners will be those who can articulate value beyond price, and its losers will discover that volume growth without pricing power is merely revenue inflation. The starkest contrast is between two alternative asset managers and one crypto exchange. Ares Management, ticker Ares, beat on both EPS and revenue, with management fees exceeding $1 billion, up 14% year-over-year. The firm raised its quarterly dividend more than 20% to $1.35 per share and reported record quarterly fundraising of roughly $36 billion. Dry powder hit a record $170 billion. The stock gained 3.2%, the best reaction in the group. KKR echoed that confidence, with co-CEO Scott Nuttall telling investors that Wall Street pessimism is completely disconnected from operating fundamentals, as the firm beat on both lines and grew management fees 26%. Then there's Coinbase, ticker Coin. The crypto exchange missed on both EPS and revenue, with trading volumes down quarter over quarter. Management offered no specific numerical guidance. The stock dropped 8.6%. The bright spot was Coinbase One surpassing 1 million paid subscribers, a subscription business growing even as spot trading softens. But the overall tone was mixed, and the market punished the uncertainty. Intercontinental Exchange, or ICE, offered perhaps the most forward-looking pricing thesis of the week. Management raised full-year guidance and emphasized that AI is making their proprietary data more valuable, not less. Recurring revenues hit a record $1.4 billion, now about 52% of total net revenue. The announced market access acquisition extends ICE's pricing power by collapsing execution, data, and analytics into a single network. Everest Group, meanwhile, demonstrated disciplined pricing power of a different sort, deliberately shrinking gross written premiums by about 7% to protect underwriting quality, as management called out what they see as irresponsible underwriting by competitors chasing risky deals. The consumer defensive verdict is unsparing. Pricing power has been permanently redistributed to the retailers who control the shelf and the premium innovators who earn the consumer's willingness to pay. The gap between winners and losers is bifurcating along these precise lines. Coca-Cola, ticker KO, is the clearest winner. The company beat on both EPS and revenue, raised full-year guidance, and posted its strongest trademark Coca-Cola volume growth in 17 years excluding the pandemic rebound, at 5%. Critically, KO delivered 3 points of pricing alongside that volume growth, a rare combination that signals genuinely inelastic demand. The stock rose 4.2% since the call. Management's tiered packaging strategy, mini cans in multi-packs at retail premium, single-serve cans as the lowest entry price in convenience, shows surgical price discrimination across income segments. Contrast that with Procter & Gamble, ticker PG. The company beat on EPS but missed revenue and struck a cautious tone with unclear guidance. PG is explicitly pivoting away from list price increases toward what it calls value reinvestment, improving Tide at the same price to win back shoppers. Management acknowledged that post-COVID growth was, in their words, 100% driven by price, and that era is over. FY 2027 guidance embeds roughly $1 billion in after-tax cost headwinds. In between, Altria demonstrated that premium pricing power still exists when you own the right brand. Marlboro retail prices rose about 7% year-over-year, while the brand held its 59.6% premium segment share. But the stock fell 8.8%, suggesting investors question whether that pricing power can offset structural volume declines. Hershey raised guidance as cocoa costs ease and pricing holds up better than expected. And Mondelez raised revenue guidance but told investors that growth is coming from volumes, not price increases, a telling signal for the snack aisle. 3 sectors, 3 different stories but one common thread. Pricing power is consolidating among companies with structural advantages, whether regulatory mechanisms for utilities, scale and proprietary data for financial services, or brand strength plus innovation for consumer staples. The beat rates were strong. 13 of 18 companies beat EPS, but the post-earnings reactions tell a more discriminating story. Markets are rewarding companies that can articulate durable pricing power and punishing those that cannot. Now let's see how this lands on our top stock and ETF picks. Market technicals. On year-to-date performance, energy stocks are the clear leader, up over 30% since January. But that leader is also the most stretched, trading more than 5% above its trend line with an RSI, a momentum gauge that runs from 0 to 100, sitting at 61, well into warm territory. The S&P 500 itself is up about 9%, sitting near the top of its yearly range at 747. But here is the breadth question. Only 55% of the names in the market are trading above their 50-day moving average, which is a plain trend line. Roughly half the market is already slipping below it. The headline looks healthy, but underneath, breadth is thin. The gains are concentrated, not broad, and that matters for anyone with a diversified retirement portfolio. Your index fund may look fine while individual holdings quietly struggle. On the risk board, the mood is mixed but leaning towards selective risk-taking. The leaders over the past 12 weeks include healthcare and financials. Financials in particular are running hot, trading more than 7% above its trend line and through the top of its recent range. That is the single most overextended area in the market right now. Running hard, due for a breath. At the laggard end, long-term Treasury bonds, utilities, and communications are all flagged bearish on their trend signals. Communications has lagged the market by 11% over 3 months. The picture is not a flight to safety. It is money chasing performance in financials while parking in lower volatility names like healthcare, which has a beta of just 0.33, meaning it moves about 1/3 as much as the overall market. On sector positioning, financials top the scoreboard with the highest momentum score and an RSI of 65, which is overcooked territory, the kind of reading where pullbacks become more likely than breakouts. At the bottom, communications sits dead last on both absolute and relative measures, down over 7% on the year. The quiet rotation worth noting is technology. It still has positive relative strength, meaning it has beaten the market over the longer haul, but its absolute momentum has gone nearly flat with an RSI of just 42. That combination, leading on the year but stalling now, is classic late cycle behavior. If you own tech funds, that is the one to watch, not panic about. On investing styles, deep value is the clear favorite, strong on both absolute and relative measures. Value stocks are not just rising, they are beating nearly everything else, with quality right behind. At the washed-out end, growth funds carry the worst relative score in the entire grid, and innovation names are nearly as weak. Both are deeply out of favor. The one rotation signal worth flagging. The size factor, plain large company stocks, has strong absolute momentum but a relative score that has drifted toward the middle line. That is early-stage money beginning to shift away from the dominant winners toward less celebrated names. On overall market health, the technical score sits at 70 out of 100, which puts the regime in extended territory. The market is running hot, not in crisis, but tired enough that the easy gains have likely been made. That does agree with the price line near the top of its yearly range, but it also warns that upside is getting harder to earn from here. On money flow, the reading sits at about 66 on a 0 to 100 scale, and our internal weekly volume analysis classifies this as accumulation. More dollars are moving into stocks than out. That agrees with the price trend. Big money is still leaning in, not heading for the exits. On sentiment, the stock Beaver composite reads about 62, which lands in greed territory. The single biggest driver is the VIX, the fear index, sitting at just 17, calm, bordering on complacency. But here is the important nuance. Sentiment has cooled meaningfully from a year ago when it stood near 82. The crowd is greedy today but less euphoric than 12 months ago. The RSI pillar at 48 is the weakest link, signaling that momentum is neutral and not confirming the optimism. The single thing a non-trader should watch this week: whether financials, the most overextended sector in the market, begins to cool, because if the leader falters, it tells you the market's appetite for risk is finally wavering. Top stock picks. Our buy signal radar is lighting up across a remarkably broad swath of the market this afternoon. Right now, more than 150 stocks are flashing active buy signals, which tells us the upward momentum we have been seeing is not concentrated in a handful of megacap names. It is broad-based participation, and that is the kind of backdrop that tends to sustain a rally rather than fizzle. Looking at the stocks with the longest consecutive buy streaks, several names have held their signals for 4 straight sessions. General Motors, ticker GM, Smurfit Westrock, HP Inc., International Paper and Copart, ticker CPRT. These are the names where the mechanical trend system says the bull case has been building for days, not just a one-day pop. Copart is particularly interesting because it sits in a defensive niche, salvage auto auctions, that tends to hold up well when the economy sends mixed signals and insurance claims stay elevated. But where things get genuinely compelling is when our buy signals overlap with our momentum and swing rankings. We call those high-confluence names. Garmin, ticker GRMN, is on a buy signal and also ranks as a top momentum stock. Willis Towers Watson, Workday, Baxter International, and ServiceNow all carry that same dual tag. On the swing side, Accenture, Cboe Global Markets, Salesforce, and Chipotle are all on buy signals while also appearing in our recovery screen. That convergence is exactly what you want to see before a name earns a spot on your watch list. Let us dig into what is actually hot this week, because the top 5 stocks by 7-day return tell a clear story about where money is flowing right now. Garmin leads the entire pack, up 20.9% over the past 7 days and sitting at $293.78. The catalyst here is Garmin's fitness segment, which multiple outlets report is on fire, helping drive the stock to a gain of more than 45% year-to-date. This is not a speculative move. Garmin makes wearable fitness devices, marine electronics, and aviation navigation systems, and the fitness business appears to be hitting a genuine inflection point with health-conscious consumers who want a device that is not tied to a phone ecosystem. Workday, ticker WDAY, is up 18.5% this week at $160.34, and the technical picture just got a meaningful vote of confidence. The stock crossed above its 200-day moving average, a signal that long-term trend followers watch closely. Workday is the enterprise software platform behind HR and finance operations for more than 65% of Fortune 500 companies, and recent partnership announcements, including an integration with EarnIn for enhanced direct deposit tools, suggest the company is expanding its ecosystem deeper into the everyday employee experience. Chipotle, ticker CMG, surged 17.1% this week to $37.24. The company just raised its full-year comparable sales guidance after reporting improved transaction growth for the second consecutive quarter. Management's confidence in new store openings and the success of its drive-through lanes, which are resonating with time-strapped consumers, is driving the rally. The stock is also showing accelerating momentum, with the 7-day gain outpacing both the 2-week and 1-month returns. Baxter International, ticker BAX, is up 16.8% this week at $26.16, and this one is striking because the longer-term picture is even more impressive than the weekly pop. Baxter's management cited steady core operating momentum alongside tariff refund benefits, and the stock has now gained 57.4% over the past 90 days. That is one of the strongest 3-month performances in our entire universe. And then there is Dexcom, ticker DXCM, up 16.6% this week at $83.45. Dexcom makes continuous glucose monitoring systems for diabetes management, and the company pointed to global demand growth, broader patient access, and margin expansion as the drivers behind its momentum. The stock shows positive trends across every time frame we track, with a particularly strong 1-month return of 21.2%. The pattern here is hard to miss. 3 of this week's 5 hottest stocks, Garmin, Baxter, and Dexcom, are in healthcare or health-adjacent consumer technology. When capital rotates into medical devices and fitness wearables simultaneously, it often signals a broader investor appetite for companies whose growth does not depend on advertising cycles or enterprise IT budgets. Now let us shift to the swing and recovery names, stocks bouncing from deep pullbacks but still carrying meaningful runway. The theme here is quality franchises finding their footing. Intuit, ticker INTU, at $316.7, shows a strong and accelerating trend despite being down roughly 60% over the past year. The maker of TurboTax and QuickBooks has had a rough stretch, but the technicals are turning, with a 6.7% weekly gain and a clean 18.3% move over the past month. When a franchise this dominant starts bouncing off a deep base, it warrants attention. Cboe Global Markets, ticker CBOE, at $310.2, is a standout with a strong, accelerating trend and the highest trend confidence reading in the swing category. This is the options exchange operator, and it highlighted record options revenues alongside a raised 2026 revenue outlook, citing broad-based growth and stronger margins. Cboe is up 25% year-to-date and 28.6% over the past year, making it one of the rare swing names that is already in a confirmed uptrend rather than just bottoming. Accenture, ticker ACN, at $165.92, is building momentum with a 12.9% weekly gain. The consulting giant just announced a collaboration with UniCredit and IBM to build Europe's next-generation banking platform, the kind of large-scale digital transformation contract that feeds multi-year revenue visibility. And Baker Hughes, ticker BKR, at $60.49, is quietly having an excellent year, up 28.3% year-to-date. The energy technology company just landed a major order for 76 gas turbines destined for data center and oil and gas applications, totaling roughly 1.3 gigawatts of power capacity. That deal underscores how the artificial intelligence infrastructure build-out is creating tangible demand for industrial energy equipment, not just semiconductors and software. Now let us pull back to the 6-month leaders, because that is where the true compounding stories live. Garmin again tops the list at 42% over 180 days. Baxter is second at 31.7%. Zebra Technologies, ticker ZBRA, at $293.82, has returned 21.4% over 6 months with accelerating momentum this week. Zebra makes enterprise asset tracking technology, the barcode scanners and RFID systems that power warehouse logistics, and that business is riding the same tailwinds as e-commerce and supply chain automation. Cboe and Dexcom round out the top 5 at 17.5% and 15.1% respectively over 6 months. The confluence worth your attention is Garmin and Baxter. Both names appear in the top 5 for 7-day returns, year-to-date returns, and 6-month returns. That kind of dominance across every time frame is the signature of a sustained leadership trend, not a short-term spike driven by a single headline. One smart money side note before we move on. Looking at the latest FINRA short interest data overlaid on our picks, the picture is fairly calm. Across the names we have highlighted today, shorts are mostly behaving, with no extreme builds or aggressive covers. That matters because it means the bullish moves we are seeing are not being heavily faded by contrarian traders. When short interest stays muted during a rally, it suggests the market broadly agrees with the direction rather than setting up a crowded squeeze dynamic. The trends we are tracking have room to run on their own fundamentals. Top ETF picks. Our ETF buy signal radar is packed, nearly 80 leveraged funds flashing active buy signals. That's broad risk appetite, not a narrow sector move. The longest streaks belong to leverage shares 2x long Adobe, ticker ADBG, and Trader 2x long Palantir, ticker PATX, each at 4 consecutive buy days. They're joined by leveraged funds tracking Netflix, Salesforce, ServiceNow, and Spotify at the same mark. When multiple single-stock tech products trigger together, that's a sector-level bid. Several carry extra conviction because they appear on multiple screens. Microsoft's Direction 2X fund, ticker MSFU, is on a buy signal and also ranks in our momentum screen. ProShares Ultra NASDAQ Cloud, ticker SKYU, has the same dual confirmation. And the China Internet Fund CWEB shows up on both the buy signal radar and our swing screen. Now remember, leveraged ETFs amplify returns and losses. They're short-term trading vehicles, not something to buy and hold in a retirement account. Keep positions small and have an exit plan. This week's hottest fund is MSFU, the Microsoft 2X product, up 45.1% over 7 days. That surge is the AI trade in concentrated form, money rotating into the cloud and software giants powering the infrastructure build-out. Close behind is PATX, the Palantir 2X fund, up 35.7% this week. Palantir's expanding government and commercial AI contracts are drawing institutional interest. Adobe's ADBG fund gained 21.6% this week, and KJD Crane shares 2x long JD.com added 19%. The JD move connects to a China recovery story we'll come back to. Also notable, SKYU, ProShares Ultra NASDAQ Cloud, up 17.2% this week and 32.2% over 6 months. Cloud computing is the picks and shovels layer of AI, the data centers, the storage, the compute, and that theme has serious staying power. Now to that China story. CWEB, the Direction CSI China Internet 2X fund, is up 17.4% this week with momentum accelerating. BABX, the Alibaba 2X fund, is up 18.1% this week. Both are still well below prior highs. CWEB is down about 42% year-to-date, but the trend is shifting from down to sideways, and recent action suggests early-stage recovery. The other recovery angle is oil. UCO, ProShares Ultra Crude Oil, is the year-to-date leader at 109.8%, a sustained move driven by Middle East supply disruptions. Reuters reports that oil prices are expected to rise further as Strait of Hormuz shipping disruptions and Red Sea attacks threaten flows. And today's EIA data showed U.S. crude output fell about 2% in May from April's record, tightening supply. UCO also gained 85.2% over 6 months. The energy leveraged complex holds the strongest technical setups. Gush, the direction S&P Oil and Gas E&P 2X fund, is up 75.7% year-to-date with a bullish MACD crossover and a golden cross in place. WTIU, the microsector's Energy 3X ETN, is up 94% year-to-date, and its sister fund OILU, tracking oil and gas exploration, is up 83.6%. All three share the same pattern, strong trends and a fundamental tailwind from rising crude. ERX, the broader direction Energy Bull 2X, is up 62.8% year-to-date, and XOMX, the Exxon 2X fund, is up 48.2%. Both got a fresh catalyst this week. According to ETF Trends, Exxon and Chevron reported second-quarter profits that surged on rising oil prices, with renewed Middle East tensions as the primary driver. These supermajors anchor most energy ETFs, so their results lift the entire complex. Two non-energy names round out the screen. CSCL, the Cisco 2X fund, is up 103.1% year-to-date. Cisco's pivot toward AI networking is finally resonating. And CPXR, USCF's 2X copper fund, is up 83.8% over the past year. Copper is the metal the energy transition runs on. Every EV, every turbine, every grid upgrade needs it. Now a look beneath the surface. Thursday's FINRA Red Show data shows the leveraged ETFs with the highest short volume percentages. Topping the panel, USX at 99.7%, NUG at 99.1%, and ZMUN at 99.1%. Most short volume in leveraged ETFs is simply intraday market making, the plumbing of creation and redemption, not directional bets. The signal matters only at extremes, and when a name overlaps with our picks. Today, none of the gold highlighted bars tied to our picks sit at extreme levels, meaning the bullish setups we discussed aren't being contradicted by heavy short seller positioning. And looking specifically at hedger activity on our highlighted funds, short volume is broadly normal across the board. No major shorting spike or short covering signal this week. The energy funds in particular, Gush, ERX, XOMX, show routine levels, meaning the oil rally isn't being fought by big money. That's quiet confirmation of the trends we see on the charts. Options activity and setups. Now let's flip to the options market. First, what the broader tape is telling us about fear and dealer positioning. Then we'll bring that read back down to the individual stocks on today's pick list. The options market speaks two dialects, what traders are actually buying and what they'll pay for insurance. Both matter. Let's start with the put-call ratio or PCR. Think of calls as bets a stock goes up and puts as bets it goes down or insurance against a drop. When the PCR rises above 1, more puts are trading than calls. Today's aggregate volume PCR sits at 1.12, essentially dead even. That's cautious, not fearful. SPY came in at 0.997, QQQ at 1.17, and small caps in IWM were the most defensive at 1.162. Nothing screams panic, but nobody's reaching for risk either. Now the second dialect, SPY's 25 delta skew. That's the gap between what out-of-the-money put insurance costs versus out-of-the-money call lottery tickets. A wide gap means crash insurance is bid. Today that skew sits at 4.35 points, which our pipeline flags as low. Put insurance is nearly the same price as upside speculation. So the PCR says cautious, but skew says calm. That's complacency dressed up as vigilance. Mixed signal. Now to the market makers, the dealers who sell most of these option bets. They hedge with the underlying stock, and how they hedge is what creates the squeeze and pinning dynamics we track. The key concept is gamma exposure or GEX. When dealers are net long gamma positive GEX, they act like a shock absorber buying dips and selling rallies. Volatility dampens. When they're net short gamma negative GEX, they act like an amplifier, selling into weakness and buying into strength. Moves get supercharged. The three indices disagree today. SPY carries net gamma of about negative 63,000 amplifier mode. Spot at 746.89 sits just below the gamma flip at 756.23, the level where dealer behavior switches from absorber to amplifier. Stay below 756 and expect sharper swings. Small caps in IWM look even more volatile, net gamma of about negative 62,600, with a flip way up at 303.60. Spot at 291 is deeply below that. IWM is firmly in the amplifier zone, but large cap tech tells a different story. QQQ carries positive gamma of about 17,000 shock absorber mode. with spot at 687.93, comfortably above its flip at 667.29. Big cap tech should get pinned near its max pain of 690 into expiration, while the broader market and small caps could whip around. Let's see where traders are paying up. Implied volatility, or IV, is what the options market expects a stock to do. Realized volatility, or HV, is what it actually did. When IV runs well above HV, options are pricing in more drama than reality has delivered. Materials through XLB are the richest sector today, IV at 28.75% versus realized of 18.8%, a ratio of 1.53. Options are priced as if XLB will swing about 50% more than it actually has. Energy is similar at 1.36. Premiums like that usually show up before a catalyst, earnings, a commodity shock, geopolitical risk. On the flip side, semiconductors through SOXX are the cheapest. IV of 57.9% is actually below realized of 68.8%, a 0.84 ratio. After the semiconductor earnings we've seen this month, option sellers still can't keep up with how much these stocks are moving. Either complacency or a bet that the volatility cools from here. 3 names worth your attention. Microsoft, ticker MSFT, shows heavy call volume, a volume PCR of just 0.249, meaning roughly 4 calls traded for every put. Strongly bullish. And MSFT also carries a house trading badge today, 2 different lenses pointing the same direction. Same story with Meta, ticker Meta PCR of 0.336 on the call side, also flagged in house trading. That's the kind of cross-confirmation we look for. For a pure options read, Oracle, ticker ORCL, stands out a put-call ratio of 0.9, extraordinarily bullish, on volume that's 85% of standing open interest. That's fresh positioning, not routine roll activity. Nobody on the Hill or in our fundamental screens flagged Oracle today, so this is a tape-driven signal, not a confirmed cross-sector play. For listeners running a covered call book, owning shares and selling call options against them for income, a couple of names stand out. ASE Technology, ticker ASX, carries implied vol of 87% with an IV rank of 93. IV rank tells you where current volatility sits versus its own past year. 93 out of 100 means you're selling options near their richest. The 15% out of the money call is pricing roughly 53% annualized. Micron, ticker MU, is similar, 78% implied vol, IV rank of 77. These are high beta semiconductor names though. The premium is rich because the stock moves that much. A covered call caps your upside on exactly the rallies that would bail you out of a drawdown, so size accordingly. Now let's bring that backdrop down to our picks. We pre-filtered the pick list and only one name qualified. It cleared the strict gamma squeeze checklist. 0 came through on the looser bullish positioning filter. Slim pickings, but let's dig in. The scorecard shows only picks where options activity leans bullish. Each row carries a squeeze phase. Pre-fire means a coiled spring, mid-fire means the amplifier is on, late means exhaustion risk, long gamma means dealers are running a dampener. Today we have one name, Workday, ticker WDAY, and its squeeze phase reads neutral or mixed. No clean directional consensus from the positioning machinery, but it cleared the squeeze checklist on structural grounds. Here's the framework. A genuine gamma squeeze setup needs 4 things at once. The stock below its gamma flip so the amplifier is on, gamma exposure actually negative, a call wall 3 to 15% above for runway, and a put wall in a similar zone below for a floor. Our rank 1 candidate is Workday at $160.34. Spot sits below the flip at $161.79, barely $1 below but below. There's roughly 6% of runway to the call wall at $170, and the put wall at $140 sits about 13% beneath. The squeeze quality score came in at 66 out of 100, with the strongest marks on runway and floor structure. Flow and skew contributed moderately. The yellow flag is negative charm, meaning dealers are technically selling a bit of stock each day as time passes toward expiration. That's a mild daily headwind into the earnings date on August 20. Workday at $160.34. Dealers are in amplifier mode. Negative net gamma means they have to chase the trend, buying into rallies and selling into dips rather than smoothing things out. The gamma flip sits at $161.79, just 90 cents above the current price. That's the line in the sand. Above it, dealers switch to shock absorber mode and the squeeze machinery turns off. Below it, every push higher gets an extra bid from dealer hedging. The call wall at $170 is where that rally would likely stall, about 6% of runway. The put wall at $140 is where dip buyers tend to show up. Max pain sits at $150 between spot and the floor. And heads up, Workday reports earnings on August 20, 20 days out. That binary event resets all of this positioning, so the read matters between now and then, not after. With only one candidate today, let's go deep. 3 metrics tell the story. First, the put-call ratio on open interest is 0.798, more calls than puts outstanding, so the positioning base leans bullish. On today's volume, the PCR is even more extreme at 0.439, roughly 2 calls for every put changing hands. That's active bullish positioning, not stale open interest. Second, the net VANA exposure sits at about positive $421,000. VANA measures how dealer hedging shifts when implied volatility changes. Positive dealer VANA means if IV spikes, say, on a scary headline, dealers would actually sell underlying stock to re-hedge. That amplifies downside on fear. But if IV cools, dealers buy back, which is supportive. With IV at 70.4% and realized at 68.6%, a ratio of 1.3, volatility is fairly priced. No obvious crush coming, but no spike baked in either. Third, the daily charm flow runs about negative $1.3 million per day. Charm tracks how dealer hedging drifts as time passes toward expiration. Negative charm means dealers are net sellers of stock each day just from time decay. A slow, steady headwind working against the squeeze until earnings reset the board. Put it together, and Workday is a structurally valid squeeze candidate with a modest quality score. The runway and floor checks pass, but the charm drag and approaching earnings binary keep conviction in check. It's the only name where the options tape leans constructive, and even that lean is conditional on staying below the flip. Remember, this whole segment is positioning context, not a trade idea. A picks list with a gamma tailwind underneath it is a higher quality setup than one without. That's the only claim. With that backdrop locked in, let's see what Congress was doing this week. Congressional Trading. Just disclosed today, 2 fresh House filings crossed the wire. Representative Cleo Fields purchased Taiwan Semiconductor, ticker TSM, in a range up to about $15,000. The transaction dates to July 10, so roughly 3 weeks before disclosure, a timely bet on the chip sector, which has been rallying on strong tech earnings this week. Meanwhile, Representative Kelly Morrison sold Honeywell Aerospace, ticker HONA, in the $15,000 to $50,000 range, a transaction from late June. Over the past 30 days, the broader picture shows Congress leaning firmly into buying. The House logged 357 trades, 200 buys against 157 sells, while the Senate recorded 131 trades with a more decisive tilt, 96 buys to just 34 sells. The House's most concentrated buy is Hubbell, ticker HUBB, with 6 purchases by a single member, a utility infrastructure play that aligns with grid modernization and data center demand. Mercado Libre and Danaher also drew multiple buyers. On the sell side, 5 House members unloaded Honeywell Aerospace, and 4 trades hit Westinghouse Airbrake, ticker WAB. Now here is a divergence worth noting. The Senate has been accumulating United Health Group, ticker UNH, 2 members buying with no sellers. But the House did the opposite, with 3 members selling UNH and none buying. Same story with Alphabet. The Senate bought it, the House sold it. Where both chambers agree is NVIDIA, ticker NVDA, both are net sellers, suggesting some congressional caution on the AI chip leader after its extraordinary multi-year run. Insider activity. This week brought zero cluster buying. No instances of multiple insiders piling into the same stock, which is typically the strongest bullish signal on the board. The 14-day buy-sell ratio sits at 0.2, with just 12 insider purchases against 652 sales. To put that in perspective, the single largest insider buy across the entire market over the past 2 weeks was $55,000 at McCormick, ticker MKC. That is effectively silence from the C-suite. On the sell side, Phillips 66 leads at about $7.4 billion, followed by Airbnb at $318 million and Coca-Cola at $110 million. Most insider selling reflects routine diversification and tax planning rather than a vote of no confidence, but the near-total absence of buyers is the real headline. The one exception sits outside the major indices. Angeliki Frangu at Navios Maritime Partners, ticker NMM, poured $846.8 million into the company's stock, a single purchase so large it dwarfs everything else on the board. That kind of conviction from someone who knows the shipping business inside out is about as clear a signal as insiders send. When corporate executives put their own money to work at this scale, even as the broader tape shows near zero buying, it pays to pay attention. Insiders sell for many reasons, but they buy for one, because they believe the stock is going higher. Federal budget. The July scoreboard tells a familiar story. The government spent $603 billion against just $346 billion in net receipts, a $257 billion deficit for the month, about $15 billion worse than the same point last year. That widening gap matters because it shows the deficit isn't cyclical. Even in a healthy economy with solid tax collections, spending outruns revenue by nearly 2 to 1. Gross receipts of $358 billion look strong until $12 billion flows straight back as refunds, leaving $346 billion to actually fund operations. Health and Human Services topped the spending list at $206 billion for the month, followed by Social Security at $130 billion. And here's a single day that captures the scale. $4.3 billion went out the door in Medicaid grants to states, one program, one day, more than many entire agencies spend in a month. Zoom out to the full fiscal year, and the structural picture comes into focus. The government has collected $4.8 trillion and spent $6.1 trillion, a $1.28 trillion deficit that's technically 6.4% better than last year's $1.37 trillion gap. But here's what that improvement actually signals. Receipts are up, but spending hasn't come down. The post-COVID baseline simply became the new floor. At this pace, we're headed for a $1.82 trillion full-year deficit, and the cost of carrying that debt is becoming its own line item. Annual interest has climbed from $1.15 trillion in 2024 to $1.27 trillion this year, on pace for $1.4 trillion. To put that in perspective, interest on the debt is now larger than the entire defense budget, and it's growing faster than any category the government can actually control. The total debt now stands at $39.8 trillion. The number is almost too large to process, so here's the translation. Roughly $119,000 per citizen, $266,000 per taxpayer. That's the share each of us would owe if we tried to settle the tab today. And the pace is accelerating. The most recent trillion, crossing from $38T to $39T this past March, took just 4.8 months. Each new milestone arrives faster than the last, which means the growth is compounding, not linear. At this trajectory, $50 trillion arrives by June 2029. Anchored against the economy, debt to GDP sits at roughly 123%, well past the 100% threshold that economists historically treat as a warning sign for fiscal stress. We're in territory the country hasn't seen since the post-World War II era, but this time, there's no demobilization dividend to grow our way out. So who holds all this paper? Private domestic investors hold the largest share, about $27 trillion, or 68%, meaning pension funds, mutual funds, and households carry the biggest exposure. Foreign investors hold $9.3 trillion, and the composition there is shifting. Japan still leads at $1.14 trillion, the UK has climbed to $949 billion, and China has been steadily reducing its exposure, now down to $659 billion. That foreign retreat matters. Someone has to buy this debt, and if overseas buyers step back, domestic buyers absorb more of the risk. Now here's where the structure turns dangerous. The average interest rate on marketable debt has climbed from 2.87% to 3.41%, a 54 basis point increase applied to $31 trillion in securities, and exactly what produced the record debt service costs we just walked through. But the real threat is the rate trap beneath those numbers. Of the roughly $31 trillion in marketable debt, about $7.4 trillion, nearly 24%, reprices within 12 months. Treasury bills and floating rate notes that roll over constantly, absorbing whatever rate the market sets today. Every 25 basis point increase adds $18.5 billion in annual interest. A full percentage point adds $74 billion straight to the deficit, which adds to the debt, which means more interest next year. The government has essentially financed itself with an adjustable rate mortgage. That worked when rates were at zero. With rates elevated, every month the Federal Reserve holds pat, the bill grows. Week ahead. 3 major reports headline what is an absolutely packed earnings week. Eli Lilly, ticker LLY, reports Wednesday, August 5th. The market will be watching for any signal on GLP-1 demand and supply. Disney, ticker DIS, reports the same day, with scrutiny on streaming profitability and parks. Then Thursday, August 6th, ConocoPhillips, ticker COP, gives us a read on whether the energy surge has staying power. The surrounding bench is deep. Tuesday brings Kimberly-Clark, ticker KMB, Emerson Electric, ticker EMR, Rockwell Automation, Western Digital, Electronic Arts, and EOG Resources. Wednesday is the heaviest day of the season. Roughly 50 companies report, including CVS Health, Uber, DoorDash, Shopify, Realty Income, Phillips 66, Kraft Heinz, McKesson, Albemarle, and Mercado Libre. Thursday keeps the momentum going with Airbnb, Constellation Energy, Datadog, Microchip Technology, Ralph Lauren, Ray's Med, and Warner Bros. Discovery. If you hold dividend-focused portfolios, several of your holdings are likely reporting this week. Now to the economic calendar. Monday opens with ISM Manufacturing PMI for July. The prior reading was 53.3, and the consensus sits at 54. Tuesday brings JOLTS job openings for June, with economists expecting a pullback from about 7.6 million to 7.25 million. A sharp drop there would reignite soft landing debate. We also get factory orders and the June trade balance that same morning. Wednesday is the pivot point. ISM Services PMI lands at 2 p.m. Eastern, and that is the one to circle. Services represent roughly 80% of the U.S. economy. The prior reading was 54. We also get private payrolls and the latest MBA mortgage rate update, which matters directly for anyone weighing a refinancing decision. Thursday wraps with initial jobless claims. Last week saw 197,000 filings, along with second quarter unit labor costs, where estimates jump to 2.7% from the prior 1.8%, plus a speech from Fed President Musalem that evening. On the IPO front, two biotech names stand out. Braveheart Bio, ticker BRVE, targets a $300 million offering on NASDAQ Thursday to advance a heart drug that posted an 86% complete response rate in Phase 2 trials. Atovia Therapeutics, ticker ATTO, is also pursuing a listing to fund its immune-mediated disease pipeline, with early Phase 1 results showing promise. It's a packed week ahead. I'll be right here breaking it all down as the numbers cross. As we near the end of the podcast, the key takeaways are this. The market is holding two incompatible bets at once. Traders are short treasuries betting on Fed hawkishness, while simultaneously piling into gold, gasoline, and VIX longs bracing for crisis. Those worldviews cannot both be right, and next week's jobs report will force a resolution. With unemployment at 4.2%, watch whether that number holds steady or begins to tick higher. For interactive charts and every number behind today's discussion, visit stockbeaver.com. Thanks for being here. I'll see you tomorrow.